Hello, this is Derek Iswell, Chief Investment Officer for Shelton Capital Management with a Shelton CIO Minute. Equity markets in the U.S. have been off to a strong start this year, with the S&P up nearly 7% year to date. This has been essentially an extension of the rally of the fourth quarter last year, which saw the S&P rise by a similar amount. But since the beginning of the year, the nature of this rally has been somewhat different. There have been two forces driving the rally. The first has been growth stocks. NASDAQ has returned nearly twice as much as the S&P, and the notorious ARK ETF, full of concentrated positions in long duration, innovative growth stocks, is up over 30% since the beginning of the year. These stocks are reacting to the prospects of lower inflation and, as a result, hopefully lower interest rates. They are very interest rate insensitive, since most of their profits will come far in the future, and any changes to that discount rate are significant to their current valuation. Now, on the other hand, we've seen a second type of stock also driving this rally, and those are the proverbial junk stocks, low quality, high leverage companies with questionable earnings, and often either cyclical stocks or companies that are in distress or near bankruptcy. The kind of rally that helps these stocks generally happens at the bottom of an economic cycle, when there's evidence that it looks like economic activity is going to improve and provide some relief for these distressed companies. The challenge is we probably can't have our cake and eat it too. It's hard for both of these types of stocks to continue to rally. If the economy remains strong, then it's likely that employment will also remain strong, and thus inflation is likely to have a harder time continuing to go down, may stabilize at a higher level, and thus interest rates may be higher than the market is expecting. Growth stocks are probably going to give back some of this rally if that's the case. On the other hand, one environment where interest rates are likely to decline is if we go into a recession. And if we go into a recession, then that will take the fuel out of that junk stock rally that we've been seeing as well. And so what we may see here in equity markets for the remainder of this year is a tug of war between these two parts of the market, trying to see which kind of economic conditions are going to allow one or the other to continue to lead. Thanks for your time. This has been a Shelton CIO Minute.